think about purchasing a home but you have no clue like where to start, well, it's okay. I'm actually here to help you. Now, if this is your first time tuning in, my name is Chakits. I'm a licensed real estate agent out here in Las Vegas, Nevada. So today I want to talk about where do we start and how do we actually start the process if you have no clue. So the first thing that you're going to have to do is actually speak to a lender. This is very important. Now, when you are speaking to a lender, you must find out who is the best fit for you because each lender works completely different from one lender to another. Each bank may have certain type of loan programs. Now, there are traditional programs out there like VA, FHA, conventional, and also jumbo loans. This is what's going to happen. Once you identify the lender that you actually want to work with, you're going to have to fill out an application because you want to get approved. And the reason why you want to get approved first is because you don't want to go out and look at homes and based upon your debt to income ratio, you can no longer afford that home because you realize you just don't make enough money or you just have so much debt. So this is where I always tell all my clients, this is where you start. It's like building a house. You want to lay down that foundation because if you don't have a foundation, then your house is not going to be sturdy. It could collapse. So this is the reason why we're going to start off with the financing part. Now, in order to go shopping for a home, you're going to have to get pre-approved. So you're going to have to fill out an application. Now, this includes a completion of your loan application and the review of all requested financial documents to determine if you meet the mortgage guidelines specified in the loan product of your application. So all this means is based upon the type of loan that you want to get, FHA, VA, or conventional, they need to make sure they get all your documents to see if you qualify for that type of loan. Now, if your financial information meets all lending requirements, a pre-approval will now be issued. So what does that mean? Can you go shopping? Yes, you can go shopping at this time. But it doesn't mean that you're fully approved. You still have to go through the processing and then you have to go through the underwriting. But I'm going to explain all that here shortly. So now that you took your approval letter and you went shopping for a home with your agent, hopefully it's me at this point. Okay. Now you go under contract, you open up escrow, your file moves along to a different department now, which is called the processing department. Now that processing department, what will happen is they want to make sure that you are fully approved before moving your file to the next step. So this is how it works. The processing will complete items such as requesting for verification for employment. They need to make sure you got a job, how long you've been there, and what type of money you are making. Also, what's going to happen is they will order the title policy through a third-party company, which is the title company. An appraisal actually needs to be done, okay? Because if they're going to let you borrow money, they need to make sure that the home is going to appraise. Also, one of the requirements is homeowner's insurance for the subject property. They need to verify that home can be insurable. If the home is not insurable, they will not touch you with a 10-foot pole. Once all this information has been gathered and they are satisfied, this is where they're going to process and submit your loan to the underwriting department now. Now, what is the underwriting department? Within the underwriting department, you have an underwriter. The underwriter reviews all elements of the loan file to ensure that all mortgage guidelines are met. So this is how it works. The company that you are doing business with, they actually have guidelines. So you have to meet all those requirement guidelines. And eventually your loan is going to get sold within 30 to 60 days once you move into the home. Now what happens is they end up selling to like Wells Fargo or Chase. They also have certain guidelines that you also are required to meet. And this is what we call overlays. So like, let me give you an idea. The company that you are working with, they may require only a 640 credit score, but they know that they're going to sell your loan to Chase. Now Chase may require 650. And this is what we call overlays. So they have to cross their T's and dot their I's. Now, should the underwriter need additional information to approve your loan, a conditional approval will be issued. If everything looks good, you are fully underwritten, approved, you're good to go. Now, through the process of purchasing a home, there's going to be ups and downs with your loan. So be prepared. You're going to have to provide a lot of paperwork. Now, typically a conditional approval is issued. What are conditional approvals? That means, yes, you are fully approved, approve, but we may need one or two documentation, or we need something to verify where did you get this money, because they're going to be looking at your financial statements and they want to see where all the money's coming in from, where is it going out. Now there's times where a consumer ends up selling a car, he gets $10,000 in his account, he's using that $10,000 for down payment to purchase a home, but they have to source it, which is they see the deposit in client's account, but you have to source it. So now they may have to write a letter, or they may need to get a bill of sale showing that they sold the vehicle for $10,000. Now, once all of the conditions have been met, the underwriting department will go through the next step, which is final home loan approval. Now, prior to your closing, the final approval is actually issued when the underwriting conditions are specified and the loan is clear to close. Now, that's what you want to hear. Clear to close, okay? Loan closing documents are prepared and delivered to the title company. Now, once the title company has all documentation from the lender, they're going to balance your settlement statement. And basically, a settlement statement is based upon how buyer and seller had negotiated a deal, who's paying for what, transfer tax, HOAs, if there's any SIDs and lids, and a part of it is your loan documentation of how much you owe in order to close out the file. This is the final step of the home loan process, okay? Now, all parties that are involved in this transaction will review and sign the loan closing documents, and they will fund the deal. Now, during this period, what will happen is you're going to receive the wiring instructions based upon how much you owe to close out on the deal. Then the lender is going to wire over their funds to the title company as well. Once you have signed, the seller has signed, at that point, the property needs to get recorded with the county. Once it's recorded with the county, now the loan is closed, the property is yours. Congratulations. Now, a couple things I want to talk about, and I think this is very important, is that we talked about, meeting up with the lender, getting approved, right? And this is just a pre-qual. Now, from a pre-qual, it goes to the processing department, then it goes to the underwriting department. Then you have conditional approval. Now, here's the thing. Anybody can go to any bank, and this happens all the time. They walk into like a Wells Fargo or Chase, they get a pre-approval, but your lender has not provided all paperwork over to the processing department. And guess what happens? You go under contract, come to find out you're not approved. Next thing you know, you got $3,000, $5,000, $10,000 in an escrow account. You could be in jeopardy of losing that money. So what I like to tell my clients is, number one, is you need to find out, first and foremost, who is the best lender? Who really has your back? Because there's two types of lenders out there. You have a mortgage broker, or you just have a regular lender that works with the bank. Typically, if you go into like a Chase, Wells Fargo, the lender only gets paid maybe by the hour or salary. So what they do is they have to meet their quota. So they are literally just issuing out a bunch of approval letters. So if they issue out 50 approval letters and only 10 sticks and their quota is only 10 a month, he doesn't care for the whole process of you going out, wasting your time, shopping, looking at homes, writing up offers, putting down earnest money deposit where you could potentially lose that. Personally, I like to deal with a mortgage broker. A mortgage broker has a little bit more favors to your loan because there's all type of loans out there. Again, traditional loans are from like FHA, VA, conventional, and jumbo loans. Now, you have to take a look at what the APR you are being charged. In addition to that, the fees. Sometimes you may have a lender may have a higher interest rates, but your fees are a lot lower, and that may compensate the difference between your monthly payment from one lender to another. So like, let me give you an example. Let's say if I go to lender A. Lender A is charging me $10,000, okay? But I have an interest rate at 5.5%. And I'm like, yo, this is great. But then my total fees to close out of this deal will be, $15,000. But then I go to a different lender and my fees are only $5,000, but my interest rate is now 6%. The question is, what is the better deal? So the first thing I would take a look at is how much am I saving? So with B, I'm saving $10,000, right? So we know it's 10 grand. Lender A is at 5.5. Then lender B is at 6%. So what is the difference? It's a half a point more. So the question is, how much more am I saving on the interest rate? Let's just say on a $500,000 home, $100 more. You know what? We'll just make it $200 more. So how do we determine which is a really better deal? So the first thing I'm going to do is question myself and say, hey, how long am I planning on living in the property? I'm going to say 10 years, okay? That's first and foremost. So now if I take 200, divide that by, so that's my $200 saving, divide that by $10,000 more that would have to come out with closing costs with. That means I would have to stay in the property for 50 months just to get my money back. Okay, so do you want to pay it up front end or do you want to pay it on the back end, right? So for me, I know I'm going to stay in the property for 10 years, 50 months. I mean, if I go 50 months divided by 12, that is 4.1 years. So what is the better deal? So if I know I'm going to stay in there for 10 years, the question is, which direction? Let me know in the comments below. I think you get this here. So you just kind of got to do the math to see if it actually makes sense, okay? And also another thing that you have to really worry about is the lender, right? Are they actually really good at what they do? Can they actually close on time? Because typically a real estate transaction takes about 30 days or less. There's some lenders that can close these deals within 12 days, which is like unbelievable because they have a good team in place. Now their team consists of 3 people, and this is what we call a pod. You have the lender, the processing department, then you have the underwriter. Now, at the end of the day, it really depends. If you went to a bank, you still have that pod, but who really controls that file? The lender may not have control of that file. It could be the underwriting or the processing department. So typically when you deal with big banks like this, their underwriting department could be on the East Coast as you're shopping for a home and doing business here in the West Coast, right? So we know that they're 3 hours ahead. Also, what happens is when you deal with bigger banks like that, what happens is your file is going to go in a queue. So if you are missing some sort of paperwork, what happens is now your file gets kicked back from the underwriting department back down to the processing department. Your lender is contacting you, say, I need this. It takes you 1 or 2 days to get those items to your lender. Now he has to resubmit it to the processing department. Processing department sends it over to the underwriting department. Now you just lost a few days. However, even though it goes to the underwriting department, closing is around the corner. You may be on the bottom of that email, and this is what we call a queue. So your queue may be 59. So now you gotta wait. So these things are actually very important to select the right lender. So typically there's 4 types of approvals: pre-qual, pre-approval, conditional approval, underwritten approval. Not too often you'll get an underwritten approval, and what that means is that that lender has taken your file over to the underwriting department, they reviewed it, and they say, hey, this person is solid. Now we're going to give you a conditional approval based upon these items. Now when you have a conditional approval, the conditional approval letter, it shows your name, it shows exactly how much you're qualified for, the loan type, and what those conditions are. Now that is a very strong approval letter, because if you are submitting your offer and you're competing against another buyer, and the agent has been in the business for some time, first thing I'm going to look at as a listing agent is the type of approvals that I have. This person has a pre-approval, but this person has an underwritten approval based upon these conditions, and these conditions are minor. It's simple, just to turn in a couple pay stubs. I'm probably going to go with this offer. Okay, so it's something to keep in mind. Now, one of the things that is most important when you are working with a lender and you're going through the application process and you're getting approved, I want you to ask for a lending estimate. It gives us the breakdown of what your lenders are going to charge you for fees, if you are buying down points, also based upon customary practices, who pays title, transfer fees. So it gives you all the breakdown, but it gives you a general idea, so that way you know exactly how much you're going to be coming out of pocket with. Because now you can use that as leverage to shop your loan, okay, from one lender to another. Because in this industry, all lenders are competing and they may cut their costs and their fees just to get your business. And that means they can negotiate your interest rate. The lower your interest rate is, the lower your monthly payment is, the more purchasing power you have. So just that one quick tip alone can save you thousands and thousands of dollars on the life of the loan, believe it or not. Alright guys, that's pretty much all I got today. If you like more information just like this, let me know in the comments below. Other than that, I wish you guys nothing but the best, and be blessed, folks. Peace.